Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So the Federal Reserve announced this week that they would be hiking the federal funds rate another 50 basis points. That has triggered a reversal on the SP 500 off this bear market line of resistance as investors brace themselves for the next leg down of this bear market. What this has effectively done, it has now put the federal funds rate, the orange line that you see on this chart, significantly above the 10-year government bond yield. The Fed funds rate, the orange line, is now at 4.25%. This chart has not yet updated their most recent announcement, meaning the bond market is essentially calling BS on the Federal Reserve's monetary policy intentions. Every single time we saw this type of development, it had massive implications for the market. Monetary policy had to pivot to pause interest rate hikes or even to lower hikes because a recession was coming closer and closer. And you can see that if I add the unemployment rate on this chart. Every time we've seen this development happen shortly after we've had an unemployment rate skyrocketing again and again and again and again. So this has absolutely massive implications for the market. We're going to be looking at this as objectively as possible to try and understand what impact this is going to have on the stock market, what impact this is going to have on the bond market, and how to take advantage of it. If you enjoyed this video, don't forget to smash the like button. It really helps push our videos out to more people. And of course, subscribe to the channel if you haven't already. Now, without further ado, let's get right into it. So another big proof that we are getting closer and closer to a big shift in the markets and monetary policy right now is on the 2-year yield. Now, you can see here the 2-year yield recently has been moving lower despite a very hawkish tone from the Federal Reserve. Now you can see again here the Fed funds rate against the 2-year yield here in blue. The Federal Reserve essentially follows what the 2-year yield does. The Fed funds rate rarely deviates very much from where the 2-year yield is at. The 2-year yield is basically a market expectation of what monetary policy is going to look like over the next 2 years. And you can see very rarely we see the federal funds rate in orange be higher than the 2-year yield in blue. And when it does happen, you can see it typically leads to a pause in monetary policy or an outright pivot in monetary policy. You can see here in 2000, again, in 1989, again, in 1995, again. And today you can see if I zoom in here, the 2-year yield has been coming down here recently, back down to 4.25%, which is exactly where the Federal Reserve has just hiked rates to. That means currently the market, the 2-year yield, is not expecting the federal funds rate to rise more than it already has. Now that is absolutely massive. And I'm going to show you by looking at the spread between the 2-year yield and the federal funds rate. So you can see throughout 2022, we've had systematically the 2-year yield significantly above the federal funds rate, meaning the spread between the two was very high, meaning the 2-year yield was significantly above where the federal funds rate, meaning that the market was expecting monetary policy to continue getting tighter in the near term. Now you can see what's been happening more recently throughout 2022 is we've seen this spread go down. It's been dropping like a stone, and look where it is now. It's at 0.5%. Now remember what I told you towards the beginning of this video. TradingView has not updated the new federal funds rate. The Fed has just hiked another 50 basis points. That means the spread is not at 0.5%. The spread is actually at 0%. Meaning the 2-year yield is at the same level as the federal funds rate. Now let me put a vertical line at every single moment where we've seen the spread go from elevated levels like we did throughout 2022 to zero where we currently are right now. So it happened in January of 2019. It happened in June of 2006. It happened in June of 2003, October of 2002, June 2000, January 1998, June of 1995, February of 1989. Now let me add the federal funds rate so you can see where monetary policy was at each of those vertical lines. In all of those instances, all of them, the Federal Reserve pivoted its monetary policy. And this actually even works during easing cycles. In 2002, that was the precise moment the Fed decided to ease monetary policy even further. And again in 2003, again in 2006, 2019. I believe that this chart is telling us that the Federal Reserve is about to pause its hiking cycle, and that's going to be a massive trade, because look at what happened to the S&P 500 in all of these cases. In the near term, stocks went up. 2000 was the only exception on this chart. 2006, stocks went up. 2019, stocks went up. That's really not a secret. The Fed pivot trade is bullish. It's good for stocks. And I believe this chart is telling us exactly that we are at that point. Now, of course, as we discussed at the beginning of the video, it also significantly increases the odds that a recession is coming towards us. All of these cases that I'm circling here did end up leading to a recession. So economic risk in this type of environment does go up. Now, in the short term, the markets are tanking. They've been tanking this week ever since the Fed's announcement. We lost this bullish structure right here, this bullish price channel, after rejecting twice off this bear market resistance line. And we're now testing this key level at 3,900 to 3,800 points. So of course it seems like we've heard this story before. This is just another one of those rejections before a major leg down in the market. Now, what I find very interesting about what's happening here is that we are seeing a big lower low on the S&P 500. But if you look at junk bonds here in orange, you can see they're moving higher. So it seems like risk assets like J&K junk bonds are not seeing the same fear that we are seeing right now in the S&P 500, not confirming the move down we're seeing. So this could really be an isolated event on the S&P 500, and that doesn't look like some of the previous reversals we've seen on the S&P 500. And let me show you what I'm talking about here. You could say this low is comparable to the low we are seeing today, this low as well. In both of these cases, junk bonds were moving down very aggressively. Again, moving down very aggressively during this period. Right now, we're seeing some strength on junk bonds. So this is telling me that perhaps the market is getting a little bit overly fearful right here, even though we did break down below this bullish structure and this head and shoulder topping pattern. So short interest right here is definitely pulling the market down. Now, that's about all I wanted to cover in this episode. Now, if you want more frequent updates, whether that's on the S&P 500 or all the key assets that we think are the best bets for investors that have around 6 to 12 month investment horizon, we do lightning reports that give you the specific entry points, targets along the way, highlighting where we're looking to book profits, where we're looking to trim positions, and then we have complete video walkthroughs of those key trades, highlighting whether we're looking to trim positions, add to current positions, and really giving just a broad overview of the macro environment and how that's going to impact the financial markets. You can click on the link down below if this is a service that you would be interested in. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to leave a like and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.